And on the long side, what does that process look like now? I remember reading The Acquirer's Multiple a couple of years ago, and which is a great and relatively quick read because I tend to lose concentration reading really long books, so that was a nice one for me. So definitely recommend checking that out if people are keen. But it seems like just looking through the portfolio, there's kind of a range of stocks. If you look at them on like an acquirers multiple basis, there's things like I saw Steel Dynamics in there at like 3 times EV/EBIT, and then O'Reilly Automotive at like 20 times, for example. So, yeah, I guess what's your thought process there? How do you approach the long side? Because it looks like it's potentially not purely just valuation.
Yeah, so no, it's purely valuation, but it's not purely deep value. So um, one of the little changes that I had was that I write pretty extensively in Acquirers Multiple about how it is the very cheapest stocks that tend to outperform over the long run. So the Acquirers Multiple compares the magic formula, which is Joel Greenblatt's idea, where he has two factors where he says, let's look at return on invested capital as an indication of how high quality a business is. And he looks at enterprise value to EBIT, which is my acquirer's multiple, to see how cheap a company is. And he says if they're good and cheap, that's a good buy, and if they're expensive and not very good, then that's something to avoid. And then there's every sort of mix in between. When I compared the two, I found that just buying cheap tends to do better, and on a risk-adjusted basis, which makes no sense. Well, like that's the volatility-adjusted basis to the extent that anybody cares about that. But you can care about that you'll notice the real pain that people feel is tracking error, which is when value's massively underperforming, the rest of the market's doing fine. It's just hard to hold value, and it does that a lot. It just tends to. It's either at a new all-time high or it's drawing down, and that's just the way that it is. And so that the drawdowns can be, they can be very, very long, years and decades potentially, which I didn't sort of really. I knew that in a theoretical sense, but having endured
Yeah.
it in an actual sense, it's very painful. It's hard to do, and you'll be kind of questioning your sanity the whole way through. I was very lucky that I had Jake Taylor there the whole time. We would talk to each other and say, I'd say, as far as I can tell, this process is still rational, and therefore I think the only breakdown is that we've lost our mind. But I think you're sane, and I think I'm sane, so I think it's okay. That's the that that's a good approach, I think. It's still a good approach. Having said that, I could see that there were still things there are things out there that don't qualify as deep value, but are clearly undervalued. And so I think that I just wanted to get a variety of different value styles into the portfolio. And O'Reilly is a good example of what O'Reilly is they sell car parts and car accessories and things like that. And they always trade really cheaply because I think that there's this, again, I hate to keep on using this word existential, but it's a good word in this instance, existential threat of cars becoming electric, this transition to EVs, and people won't be going into O'Reilly as much. As a result, it throws off enormous amounts of cash, and management's been very good for a very long time at using that cash to buy back cheap stock. And so that the thesis there is just a cash flow engine that buys back stock, and you end up doing quite well in businesses like that. And so I'm always on the lookout for that style of business. I'm also on the lookout for things that are just absolutely cheap. If something's trading at 2 or 3 times, sustainable earnings of what it could do over the next few years, I think it's worth taking a look at, particularly if management is doing something about the undervaluation. So in any given quarter, because I rebalance quarterly back to equal weight, in any given quarter, it's funny to look at the styles that work better in the portfolio. So if you were to look in the portfolio, say a year ago, it was more of the not shallow value. That's not a very good name for it, but like the better quality value companies were doing a little bit better. And then we've had this like commodity bubble boom as well, where for whatever supply constraint reasons or whatever it is, commodities have run really hard. And so this quarter, if you look in the portfolio, all of the stuff that's outperformed is all of the commodity more traditional deep value. So if you look at the portfolio now, it looks like it's weighted towards more sort of commodity, deeper value stuff. And I'm just trying to get both into the portfolio. I'm trying to take anything that's undervalued in a pretty wide range because I don't want to predict which one's going to work. I think that there are a lot of people predicting now that it is going to be a deep value run, and it is the cheapest decile or the cheapest quintile that has, and that's the cheapest fifth, the cheapest 20% or the cheapest 10% of the market that just hasn't participated. And all of the other, so that you can divide the market into 5 buckets on a value metric like enterprise value to EBIT, my acquirer's multiple. And the most expensive bucket, that's the glamour stocks or the growth stocks or whatever you want to call it. And then the cheapest bucket is like the deep value stocks. And this analysis that I think it's GMO who's just brought it out, they say that buckets, the most expensive bucket, bucket 1, bucket 2, bucket 3, are very, very overvalued. But then they say bucket 4, which is getting close to being deep valued, is also overvalued relative to its long run history. And the only place that you can find value is in that deepest value bucket. And so everybody seems to be guessing now that it's going to be a deep value run and trying to concentrate into deep value. I think that's probably right. I think that's probably what happens, but I don't know. And this, if anything, if I've learned anything in the markets, it's that whatever you think is going to happen is going to be confounded by something that you didn't expect or you didn't predict. And so I just try not to predict anymore. I just try to say, I don't know what's going to happen. I'm just going to be in the most undervalued stuff the way that I assess it. And I hope that it works out. Let the cards fall where they may.
If you enjoyed this clip, check out the full episode here and subscribe here. Thanks for watching.